we go. All right. Everybody's in. We'll kick this thing off. I think we may have a couple of stragglers on the way. 1 second here. Close that. All right. So thanks everybody for hopping on the call. I'm going to do a quick screen share and put up the disclosures to make Cambridge happy. All right, I've now done that, so we can stop the screen share. All right, so purpose of today's call. This is the first in a monthly series of video recorded sessions where we are going to cover some various items associated with the state of the firm, Phillips Financial Strategies, and we're going to go over basically 3 specific kind of segments each call. These calls will also get saved and then uploaded onto our brand new YouTube channel, Fresh for 2021. So with that, I'm going to dive into the housekeeping items that are kind of important. I want to welcome everybody and say thank you for taking time out of your day and hopping on the call, especially all of the staff from the Brand Trust who are here and Derek Allen from JP Morgan coming out. Before we dive too much into the presentations and various stuff, everybody may notice that your videos are off and your mics are muted. That's for privacy and conforming with our privacy policy for everybody. If you have questions for the Q&A session, my request is that you send them to my email address, william@phillipsfinancialstrategies.com, and we'll moderate and ask those of Derek. So that way no one feels as though they have to be called out on the line. So those are the compliance items for the call. And for some of our stragglers that we've got coming in here, I'll remind you again at the end that you'll be emailing your questions to me for the Q&A session. All right, so on to the next piece. Firm update. I mentioned the YouTube channel. We are going to be rolling out a YouTube channel, and Caitlin is going to be sending an email when that's available for everyone to go ahead and see. And we'll make this video available, and then we'll be making additional content available as well on that YouTube channel. So check back with us, go ahead and subscribe to the channel, and you'll automatically get updates. Otherwise, we'll periodically be pushing updates out. Next item on our list. 2020 was quite a year in many ways. It was our first year as our own RIA, which is Registered Investment Advisory Firm. One item on our housekeeping list that I want to bring to everybody's attention for our RIA is that DSBE, the powers that be at the Department of Insurance, Securities, and Banking at DC, have asked us to get addendums for our investment advisory clients. And it's just so that way everyone is acknowledging that we are in fact utilizing those forms for making our recommendations. It's a procedural housekeeping thing, and we'll be reaching out to make sure that folks, if they have any questions and folks that need to sign them, you'll see the emails come through. They are legitimate. If you want to ping us back and confirm it, go ahead, and we can also go over that with everybody in greater detail when those documents come out. Next, we're also going to be, as we typically do Q1 of every year, we review all of our record keeping, make sure our database is up to date. You all may have seen a mailer from Cambridge. We do our own and make sure that we follow up. So if you've got an expired driver's license on file with us, or it's been a while since we've updated certain pieces of information in our database, we're probably going to reach out to you. So you may hear from Mariah or Caitlin or Charles or myself or Lindsay just keep an ear out, and want to let you guys know that's what we're up to. All right, next on the list, portfolio updates. So simple, straightforward. As you all may have noticed in your accounts, the dollar figures have gone up despite having a difficult year in 2020. And so we're going to be doing some rebalancing, and we're going to be swapping out a couple of funds because of general fund closures on the mutual fund side, and also overall investment allocation. So you'll see a couple of things get swapped out over the course of the year and over the course of the next few weeks. And so if you have any specific questions as to like why we're doing it or how it pertains to you, I'm happy to set an appointment, kind of go over some stuff from the logistical standpoint in a more private setting. So I hope that's okay with everybody. Next item on the note, and this is also pertaining to our rebalancing, is that you may have noticed or heard in the news that interest rates have crept back up. The 10-year Treasury note, for example, has moved almost 0.5% higher in the last 6 months. And so that's actually kind of a big move for the 10-year Treasury note. And so we have to adjust our portfolios accordingly with regard to asset allocation when it comes to fixed income and bonds, that sort of thing. And then last on this list, before I turn things over to Derek, is going to be, if you're one of the few folks that have required minimum distributions needed for 2021, we just got all of the data from our cashiering platform last week. I am working through it. And so you'll A, see trades in your account, B, will probably be reaching out to say, hey, how do you want to receive these? Do you want to get them monthly, quarterly, annual, etc.? Do you have charitable contributions in mind? So just be on the lookout for emails and requests related to those couple of specific items. So that does it for the housekeeping stuff with Phillips Financial Strategies for today's call. Which means that it's time for me to turn things over to Derek Allen, our presenter. Derek has been a Capitol Hill resident. He and I have known each other professionally for a number of years. I've found him to be an incredible resource, and also offering some pretty good insights from the economists and the investment portfolio team over at JP Morgan. And I guess without saying too much more, if you live on the Hill, you may have actually seen Derek, so you may recognize this face, walking a dog or pushing a baby carriage with his wife. So anyway, that's all I will do to try and make him laugh and blush. With that, I'm going to turn it over to you, Derek, and I'm going to push a couple of buttons here and give you power to present and share your screen.
Thank you, William. Appreciate it. And I think the one with the picture is the one where I'm going to want to share the screen. So if you want to grant that's the iPad sitting in front of me. I've adapted my home office here in Capitol Hill to this brave new world where I used to spend very little time in the office and a lot more time out seeing clients and sharing some of our views. And the way that we've expressed those views is through a resource called the Guide to the Markets. It is a publication that we've put out for north of 15 years. It is facts, it is figures, it is data. It is a combination of all of the things that you may see on Fox Business, on CNBC, on CNN, whatever network you decide to watch, and I have to be careful which networks I say these days, you will see some of these numbers, like unemployment data, like the Federal Reserve policy. And what we're going to try to do today in a very short time is hit on actually 15 slides from that deck. There are 80 slides in the presentation, so we have, believe it or not, narrowed it down to the most relevant to 15. But we're going to try to do it very quickly, and we're going to try to hit on a couple of points. We're going to address the conversation as it relates to the reopening of the economy, the potential inoculation of a population here in the US, and what that means for economic growth. We are going to try to address the policy response, so both the fiscal and monetary response, and the magnitude to which they acted domestically, but also the foreign intervention that took place. But more importantly, this is an investment conversation. So we're going to talk about what that ultimately could mean for portfolios in 2021. As William had alluded to, last year was an interesting year to say the least. We all felt really, really bad, but our portfolios may have ended up looking pretty good. And that leads me to maybe the first point that we would want to talk about in today's conversation. And that is a book that actually sits behind me. It's called The Most Important Thing. It is written by a gentleman named Howard Marks. For those of you that are not familiar with Howard Marks, it wouldn't be an investing presentation if there wasn't a Warren Buffett quote. Instead of using the traditional Warren Buffett quote, I actually chose to quote a guy that Warren Buffett actually asked to write the book that sits behind me. Howard Marks is a investor and has been an investor for a very long time. He wrote these newsletters or quarterly memos that he would publish and he would send to folks, including Warren Buffett. Warren liked them so much, he asked them to put the best 19 things in a book. And one of the things that Howard Marks says in the books that relates to our conversation about what happened last year is the quality of a decision cannot be determined by the outcome. So again, the quality of a decision cannot be determined by the outcome. There were a lot of people that had good outcomes last year in the stock market. The amount of retail trading that took place last year through sources like Robinhood, Schwab, Vanguard, and such were up almost twofold and continued throughout the course of last year. And given the way that the market fell off in March and April, a lot of people looked pretty smart. And one of the things we often say is don't confuse brains with a bull market. We started a bull market in April of last year. And the quality of the decision-making process that's gone into allocating capital and or investing in the market over the last several months is arguably average at best. And one of the things that we always try to point out is you want to improve the process by which you make those decisions. William mentioned the time that we spent working together. I've been working with him now for almost 10 years at JP Morgan. And one of the things that I've always enjoyed about my conversations with William in the office is just the quality of the decision-making process. It doesn't always get it right. Nobody does. And if they tell you you do, you probably want to run away. But the only thing that we can really control is how thoughtful or what type of information do we put into our investment decisions. And it's something that I commend William on and would be remiss if I didn't mention at the start of my comments. But certainly something that we want you to keep in mind as we go into 2021 and 2022, because we do think it's going to be a market that's likely to be defined by more quality decision making, as opposed to just putting money into depressed assets. In order to go through this, I'm going to kind of start with the micro and maybe move out to a broader view. In order to do that, I'm going to make mention of somebody that everyone on the line here may know, and that's Harry Houdini. So for those of you who didn't know, Harry Houdini was an amateur boxer. In addition to all of the stupendous tricks that we saw throughout the years, Mr. Houdini would often have people come up from the audience, often the largest, strongest looking individual in the crowd, both male or female, and give him a nice solid punch in the gut. And he would do this without any real flinch. And this was something that he often did and something that wowed the crowd at his ability to withstand the blow. One day in 1926, after one of his magic shows, he asked a group of children to come back behind the stage. One of the children, seeing what had happened on the stage with the punch to the gut, walked over to Mr. Houdini and started repeatedly punching him in the stomach. He wasn't ready for it, right? Later that day, Mr. Houdini ended up dying from a ruptured appendix. And I bring that up as it relates to page 18 of the Guide to the Markets, because risk, in this case, a punch to the gut, is often the thing that we don't see coming, right? And on page 18, we show you what risk means as an investor. Each little red dot on the page is risk. That is the amount of downside or stock market decline from a peak to a trough in any given calendar year that you had to experience, right? The punch in the gut, in order to participate in the upside, right? And the upside are the gray bars. And then the takeaway in the top left-hand side of the page is in 31 out of 41 years, despite an average annual inter-year drop of 14.5%, which is a pretty big punch in the gut, you ended up making money in the stock market. And that's the real takeaway, right? Risk is the thing that you don't see coming. right? On the right-hand side of the page, last year we experienced almost a 34% decline in the market. Why was the market down 34%? Well, it ended up being not from Ben Bernanke's economic policy. It didn't end up being from a trade war with China. It didn't end up being from the hundreds of other things that we worried about over the course of an 11-year bull market. Instead, it came from a virus, right? Something that nobody could prepare for. And so what we try to emphasize is the idea that these little red dots or these risks are going to happen in the market. But it's important to take a longer term perspective. And for that, we look at page 21 of the guide to the markets. And as we often say, we want to invest like a invest like a optimist, but save like a pessimist, right? And the idea here is that over the course of the last 100 years, there have been a number of reasons as to why we might have wanted to get out of the market, right? Each of these little red dots happened throughout this time period. And if you go back even further, you'll see a number of other things that occurred. I would just point out that during this time period, you've obviously seen the stock market go from the lower left to the upper right. It's been one of the the greatest wealth compounder in history. But despite all of that, we had 1.3 million people die in 9 major wars. 99.9% of all companies went out of business during this time period. So there's 500 big companies that sit around today that we talk about often is the S&P 500. 99.9% of companies have actually gone out of business during this time period. 675,000 Americans died during a flu pandemic. We've had 33 recessions that lasted 48 cumulative years. And those are the gray bars that you see on the page. And stocks have lost a third of their value 12 times during this time period. Despite all of that, the standard of living has increased by over 20-fold, but barely a day went by where we didn't have a real reason for pessimism. So again, we want to invest like an optimist as we go through today's presentation, but think about saving like a pessimist, right? That things will happen. Inevitably, we'll have those risks. We'll get those punches to the gut. We'll likely have another one this year of 14% or so. We don't know why, we don't know when. And that's where risk ultimately gets people. It's the stuff that you don't see coming. So what are the potential risks to the market? We would obviously have to start with page 23 of the guide to the markets, which is the virus that we all still find ourselves very much in. And if you look at the slide 23 from the guide to the markets, what you'll see is things don't look good. We've seen a significant uptick in cases. More importantly, we've seen a significant uptick in fatalities. And those numbers continue to escalate at a pace that is obviously concerning. Within this chart, we did get some good news, right? We got news that there is a vaccine and now a number of vaccines that are showing efficacy rates north of 90%. And that is something that is ultimately going to allow the economy to reopen at some point. But it's not going to be anytime soon. More than likely, we're looking at months before we get a full inoculation. Last I saw, we're around 8 million people in the US that have received the vaccine. My mother, fortunately, was one of those this past week. She's a healthcare worker. She gets her second shot on the 26th, and we are looking forward to her meeting her granddaughter for the very first time. So that will be an exciting point in our lives. And really, it's individuals like my mother, as we zoom in on the page here, that are the ones that are most at risk and most likely need to receive the vaccine before we can get a full reopening of the economy. Just to put it into perspective, for those over the age of 65, they represent about 16.5% of the population in the United States. They represent 80% of the fatalities. So there was news today, and it's breaking news, I guess, or continuing news as to the policy to try to increase the number of 65-year-olds that will be vaccinated under the Biden administration. But without that vaccination, or without that the vaccination of a greater number of people, we're going to continue to have this overhang of the virus, and it's going to continue to be a risk to the market. Now, this risk was not without response. And if you look at page 22 of the guide to the markets, you'll see on the left-hand side of the page, the decline in economic growth that we saw from the virus. What you'll note is that blue dotted line is the trend that we were on. So on January 1st, or 12 months ago, this is the way that it looked like the economy was going to move forward throughout the course of the next couple of quarters and years. The gray line is what happened. And what you can see is the bounce has been pretty impressive, right? Off the lows of the second quarter of this year, we've seen a pretty substantial uptick in economic activity. But as we often like to say, this is the equivalent of jumping off of a cliff onto a trampoline. Yeah, the bounce is impressive, but more importantly is the jump off the cliff, right? We are still well below the economic potential output that we could be at were it not for COVID-19, right? And that's going to take time, and it's going to take a vaccine or a complete or mostly vaccination of the United States. Because if you look at the right-hand side of the page, almost 68% of the economy in the United States is consumption. So if we are unable to spend, it doesn't matter whether or not we have money to spend, which is the current situation that we find ourselves in, because we're not going to be able to go out and do it anyway. There's a computation that looks at the spending potential of people in the United States, and it looks at the actual consumption in the United States. And the gap that we see between those two things today, so the potential to spend and the ability to spend, or the actual spending, is the largest that we've seen going back by a factor of tenfold. So this at some point will pick up. Which means at some point we will see an improvement to economic growth. And we do think that's something that's going to begin really in the middle part of this year. We don't want to be overly ambitious, but we do think there's a good possibility with the addition of a Johnson & Johnson vaccine likely to come out this month and probably any day now. Assuming that you get a positive reaction there or an efficacy rate at a similar level to what we've seen from others, you're likely to see a reopening of the economy in some sorts. We think at some point in April. And that is hopefully not too optimistic. There are murmurs of March being a possibility, but it's going to take a real ramping up of the vaccines and the available vaccines in order to make that happen. We also need it in the form of the potential to hire. So again, if you look at page 31 of the Guide to the Markets, employees of total non-farm payrolls, we had another jumping off of a cliff onto a trampoline scenario. We've seen the unemployment rate go from almost 14% back down to about 7%, 6.8 roughly. And that ultimately is a good thing, right? But we're still well short of where we were when this whole thing started. And the problem is particularly profound in certain areas of the economy. On the right-hand side of the page, you'll see that leisure and hospitality, for example, still only at about 53% of the level that it was at prior to the crisis. We are still looking at about 31 million people in the United States affected by a social distancing economy. And those people have not been brought back as you look at trade, as you look at education and health services, and professional and business services. Would also note that 6.8% unemployment rate that we're at today is a bit misleading. There are a lot of people that have not gone and started to look for jobs again. So if you actually include the number of people that at some point will re-enter the job market and become an active searcher again, we are looking at an employment rate that's still close to 8.5 to 9%. Again, a lot of room to improve. Quickly on high frequency economic activity, very simply, people went out and started to spend again fairly quickly. If you look at seated dinners, for example, we're still about 60% off of our peak. But if you look at mortgage applications, you would see that we're about 3% above where we were at the start of the pandemic. So depending on where you're at, there is an increase in spending. Consumer debit and credit transactions, for example, working for JP Morgan Chase, we see our Chase customers are actually spending more money than they were pre-crisis on their debit and credit cards. So all of these things ultimately have an impact, not only domestically, but globally. And there's a lot on page 61 of the Guide to the Markets, but really what we're looking at here is a global composite purchasing manufacturers index. Said another way, this is a private sector survey that's done by Market. They go out and ask companies, do you feel as though you're going to expand, contract, or keep your business the same, both services and manufacturing? It's a composite of the two. And what you'd see is green on the page is good, so things are getting better. Red on the page is bad, things are getting worse, and not surprisingly, things got really, really bad for a couple of months. But as you look at the global picture in the top line here, and as you look at certain countries, you'll see that there is actually green across the screen. So in areas like China, India, Brazil, the United States, and Germany, you're actually seeing green, whereas in places like Italy, Spain, and the Euro area, broadly speaking, given the size of those economies, we're still in kind of an orange to red area. which says there's room to improve, but you're already seeing a pretty vast improvement across the globe. Now, this pandemic has been an expensive one, right? As we think about not just the virus and the possibility of turning a page at some point in the spring or summer of this year, we must also look at the response. And first, on the federal side, so this would be the fiscal response, the response that we saw from the federal government in the form of stimulus and the additional stimulus that is likely to come through is meaningful. In the bottom right-hand side of the page, we are now looking at a federal net debt to GDP ratio that is as high or is the highest that we've seen going back to the Second World War. And that is a meaningful thing, right? First of all, it was necessary, and it continues to be necessary as we deal with this pandemic, but it ultimately is going to have consequences. And one of those potential consequences is higher taxes, a potential change to entitlements, and more likely than not, you're going to have a government that is left dealing with this problem for years and potentially decades to come. So the response, while effective and necessary, is likely to go on for a very long time. The same is true on the monetary side. We are likely to see a Federal Reserve that remains extremely accommodative, and we would define accommodative as a low interest rate or zero interest rate bound on the short end of the curve for the next several years. The Fed previously had a mandate of inflation and employment targeting. They have gone to an inflation targeting method. Their expectation is they would need to see inflation north of 2% for 3 consecutive years in order to start to think about raising rates. Well, the potentially good news or the bad news is that inflation rate is creeping back up. And what that could mean is that while the Federal Reserve is telling us today they're not going to raise rates likely before 2023, that could come a bit sooner. And while the Fed controls the short end of the curve, if inflation expectations are picking up, the economy is picking up, you're likely to see a scenario in which the yield curve can actually steepen, which is to say that longer term rates go up, and that would ultimately have an impact of driving up the cost of a mortgage, for example. So a 30-year mortgage going up. It could also have a negative impact on a fixed income portfolio. So as we start to think about a recovery, the normalization of interest rates means that we go from a 50 basis point 10-year treasury or 0.5%, which was near the lowest in history, to something that's a bit more normal. And whether that's 1.5 or 2 or 3% at some point over the course of the next couple of years, there is a backdrop of global synchronized growth coming out of this virus and coming with a vaccine that has the possibility to drive interest rates a bit higher. Now, it's going to have impacts on the equity side as well. So real quickly, again, we have seen a more profound jump off of a cliff in the equity market that has led to a bounce that's actually well above where we were at prior to this crisis. So we're now at all-time highs in the market. We are borderline euphoric as we look at equity prices today. And we are now looking at a multiple on the S&P 500 that's trading around 22 times. What does that mean? Well, it means that the largest 500 companies in the S&P 500 are now trading at about 22 times their their next 12 months of earnings. So if you're an equity investor, you're entitled to 3 things. You're entitled to the earnings of that company, and that over time is what's going to drive your return, a dividend if they happen to pay it, and then some sort of multiple. So what are you willing to pay for those earnings and dividends? Right now, people are willing to pay a lot. And one of the questions that we often get is, why is the equity market doing so well while the economy is doing so bad? So I alluded to this a moment ago, but the economy on the left-hand side of the page is actually representative of about 20% socially distanced sectors. So 20% of the economy is directly affected by the virus, 20% of the employment market, again, as we think about the service sector in particular, is affected by the virus. Only about 7% of operating earnings in the S&P 500 are directly affected by the virus. And a big reason for that, as you look at the right-hand side of the page, is the emphasis on technology. Technology makes up almost 38% of the earnings of the S&P 500, and has been a big reason why we've seen things continue to go higher, despite the fact that the economy has felt so bad. Now, the question is, where do we go from here? And as you look at page 5 of the guide to the markets, again, I mentioned the multiple is a factor of what are the earnings on the S&P 500. Well, over time, your stocks or your equity portfolio should track your earnings. And as we look at page 7 of the guide to the markets, despite the fact that the market is a bit expensive at this point relative to its own history, the trend of the blue bars on the right-hand side of the page is higher and higher yet. So we are likely to see record operating earnings for the S&P 500, or the largest 500 companies in the United States, next year. And that ultimately means that we should have a record stock market return, right? The price of the stock should be higher if the earnings are higher. Into 2022, we're looking at earnings growth. That's again, next year, we're expecting about 26% earnings growth. The year after that, almost 17% earnings growth. What that would tell you is that despite the fact that the entry point is a bit high as it relates to the price that you're paying, the value that you get and the growth of those earnings over the course of the next couple of years is very profound. Now, I mentioned in my opening comments, you have to be selective, right? We want to be thoughtful in the decision-making process. One of the things that's defined this bull market is the top 10 stocks and the contribution to return of those stocks. Just think FANGMA, right? Facebook, Alphabet, Google, Microsoft, Netflix. Those stocks account for what is now almost 28% of the S&P 500. So 28.4% of the S&P 500. So when you put a new dollar to work in the 500 largest companies in the US, 28 cents of that is actually going into just 10 stocks. Those 10 stocks on the left-hand side of the page are about 172% of their long-term average. Said another way, they're more expensive than the entire market, and they're a lot more expensive than the other 490 names in the S&P 500. So there's an opportunity to diversify out of just the things that have done well, and to think about the opportunity set more broadly speaking in smaller cap areas, in the value space, which has been very much out of favor and less of a technology focus, and should benefit from a cyclical reopening of the economy. Now, I'm not going to spend a lot of time here, but if you think equity markets are expensive, page 47 of the guide to the markets would tell you fixed income is just as expensive, if not more. We're seeing an environment in which spreads have come in, and spreads would be basically a determinant of your risk in fixed income, as the Federal Reserve has stepped in a meaningful way. And all of that has led us to an environment where fixed income as a asset class has some, again, selectivity to it, where we want to be thoughtful about what we own and why we own it. But it can't just be a broad-based approach where we're putting money to work. Now, the final part of my comments, as I am over my time, just relates to doing the right thing, right? I mentioned in the volatility slide at the open, risk is the stuff that you don't see coming. We can't control what ultimately happens in the market. We can only control how we act, or how we react to what we're given. And what we're showing on page 74 of the guide to the markets is the top of the page is 3 portfolios. So all equity, 60-40, 40-60. So 60% equity, 40% bond, and vice versa. And what you'll see is that given the pullback that we saw in March of last year, the all equity portfolio went down by more, and it took longer to make the money back. So you were in the red a bit longer than had you been in a well-diversified portfolio. In the bottom of the page, what we show you is that the average person doesn't hang on to that all equity portfolio. The orange bar that says average investor is indicative of flows into and out of mutual funds in the subsequent 12-month return. So if you bought a stock on March, or a equity fund on March 23rd, what was your return for the next 12 months? It says the average investor has made 2.5% a year. A 60-40 portfolio has made 5.6. And oftentimes people balk at these numbers. Page 72, I'm not going to go into the full detail here, backs that up, right? The equity market ended up being positive last year, and certain parts of the equity market very much positive. The flows into and out of registered products were $200 billion out of equities, $40 billion out of world equities, $365 billion into bonds, and $684 billion into cash. There is still $4.1 trillion of money market or liquidity funds sitting out there of people that are worried about the risk of what is going to potentially happen. So how do we prepare for that? And how do I end my comments? I end them with page 71 of the Guide to the Markets, and that is that we can't determine what risks are ultimately going to hit us. We can't always know where the punch in the gut is going to come from, so we have to prepare ourselves, right? We have to flex our solar fourplex and prepare for the hit that eventually is going to come. And one of the ways to do that is to build a diversified approach. And as you look at page 71 of the Guide to the Markets, what you'll find is that asset allocation, which is the gray bar in the middle of this page, which is a culmination of all the other investable assets on the page, does not work at any given point in time. So it's never the best performing box on the page, but it works over time. It annualizes the return that you need to meet your financial goal or objective, and it does it with substantially less risk than any particular bet on an asset class in any given year. So with that, I will wrap up my comments. William, I will pass it back over to you. Again, I thank you for the thoughtfulness of your decision-making process and allowing us to be a part of it. And ultimately, I just remind everybody on the line, risk is the stuff that you don't see coming. We don't know why the market will be down this year. We don't know why the market will be down next year. But over time, it's best to invest like an optimist, save like a pessimist, stay diversified, and flex for that potential punch to the gut. So William, I'll pass it back to you.
Derek, thank you very much for your comments. At this point in time, I'd like to open things up to a sort of Q&A period. I mentioned at the very beginning, as a lot of folks were just kind of logging in, if you do have questions for us, go ahead and email them directly to me. We're trying to kind of keep everybody nice and private, not have anyone have to call out. So with that, we'll give it a minute or two and for those questions to come in. And I'm going to actually pose a question of my own to Derek here. To quote Dr. David Kelly. So he often says that the start of a climb in interest rates often leads to more buying and creates an arc that ultimately drives interest rates back down. Where since fixed income is every bit as expensive as the equity markets, where are some of the things that look cheap? And to quote our friend Mike Berman, where are some of the landmines? Where are some of the gold mines that are kind of identified in the Guide to the Markets?
I would say on the interest rate side, one of the things that we didn't talk about is, the 10-year Treasury is now north of 1.15%. At some point that starts to attract assets because as I look at the 10-year German Bund, it's negative 48 basis points. So at some point, German investors or non-US investors could potentially put a cap on the rise to interest rates as that interest rate becomes substantially more attractive to the rest of the world. But what you do see around the world is, Italy, for example, at 63 basis points, one of the highest levels we've seen in a while. China is at 3.1%. Even Japan is in positive territory, which is a win for Japan. So as we see that global synchronized growth, you're likely to see interest rates around the globe go higher, which may limit some of the pressure and allow interest rates in the US to potentially drift higher than they have for the last 10 years when you've had this basket case of the rest of the world that has not dealt with monetary policy very effectively. As it relates to the opportunities, we would say there's a lot of opportunities, right? The shopping cart is probably looking for a lot of the stuff that hasn't worked. So, we're looking at areas of the market like value, right? Financials have been extremely out of favor. JP Morgan stock up 41% over the last 3 months. So we've had a very nice recovery, but still just getting back to levels that we were at prior to the pandemic with an earnings backdrop as we didn't see the type of defaults that we potentially would have seen. Not an endorsement to buy JP Morgan stock, but we say the financial sector, broadly speaking, represents some undervalued assets where you can get stuff that's still trading in the single digits or about half the price of the market as it relates to their multiple. Traditional energy is a bit of we'll call it a bottom feeding exercise, but one that potentially has some value to it. It's one of the few areas of the market that's still relatively cheap. And if you can get some high quality assets there is opportunity as it looks like oil prices have stabilized. It would be remiss to talk about a Biden administration without talking about sustainability. There's likely to be an infrastructure bill that puts through budget reconciliation. And infrastructure spend has a positive impact on certain areas of the market. And that is going to ultimately lend itself to a continued push towards sustainable and renewable energy. And a lot of companies there have experienced a boost since the election. We think that probably continues to persist. So electric vehicles, solar, wind, likely to be an area of opportunity as we move into a new Biden administration. Two of the areas of potential threats or landmines that you could run into is actually two of the things that have worked pretty well. One would be big cap pharma. So regulation is likely to be a defining factor of this administration. Changes to the healthcare world and particularly healthcare pricing, given that it is a very narrow spread of power that exists. It's actually the tightest spread of power that we've seen in a one-party rule since 1901. So don't expect a whole lot of very partisan stuff to get through. But one of the things that we think could get done by executive order is drug prices could be acknowledged and or changed. And the other one would actually be big tech. There are a lot of people down the street from where I'm sitting right now that are very shook by what happened last week. And they have put an emphasis on the role that social media played in what took place. There were already DOJ suits against Facebook and against Google. And we think antitrust is going to be a defining story for the next 4 years as we think about a Biden and Harris administration. So that could mean some of those big tech names that have done very, very well could be challenged. So just a couple of landmines and potentially gold mines, depending on how policy shakes out.
Perfect. So that sort of validates the commentary for diversity within portfolios and regular rebalancing, which is a drum I beat on a pretty regular basis. With that, I did promise everyone that we'd be on and off the call in about 30 minutes roughly, based on Q&A as well. I haven't seen anything come through into the inbox yet for Q&A. And so with that, what I'll do is I'll bid everyone a wonderful evening and let everybody get to dinner and happy hours. And we'll wrap up this recording and it'll be up on the YouTube. So with that, everybody have a wonderful evening. I look forward to seeing everybody again in person soon enough. It's been far too long. We've been doing this for a year now. But until then and until next time. All right. See you all soon. All right. Bye-bye.
Thank you. Be well.
Yep.
Thank you.
You're welcome.